Good morning, curious investors. It's another great day. The sun is shining so brightly I had to turn my camera around to get the glare out of the screen today. Hope your day is going well. We got a lot to cover today. I'm here to answer questions if you have specific questions. If you don't, I've got plenty of material to encourage you with. And so we're just going to jump into this and have a great day today. Let me throw our disclaimers up here. Investing is a risky proposition. You can lose money. That is a big deal. I don't like to lose money. Hopefully you don't either. And we'll make this a little bigger, so make sure you see this. Curious investors, today we're going to talk about capitalism and capitalization. And if you wish to remain unidentified from a recording, please remove your name and your face from the screen. We have no crystal balls. It's strictly our opinions. Stock investing includes risk. You can lose money. Stock prices go up, they go down, but the riskiest part is generally when they go down, you lose money. No dividends are guaranteed, and any references to specific securities here are for illustrative purposes only. We are never going to make a specific recommendation on our show because we're never around you to tell you what to do. If we were to tell you to buy XYZ company, we wouldn't tell you when to sell it because we don't know what you did. So don't make any specific actions from this particular show. Content provided is for general information, is not intended to provide specific investment advice. So I hope you get that. You can read on down below here. LPL Financial is who we offer securities through. They're a member of FINRA and SIPC. They are separate from Gimbal Financial, which is what this next bullet says down here. Get down there. And so we are two different entities. We offer specific advice. We're a registered investment advisor, but we are not part of LPL as a employee type situation. So there you have it. That's the risk. If you go outside today, you could get hit by a car. If you go fishing, you could fall in the lake. If you do a lot of things, life can bring risk. But there is no risk, I don't think, sitting right here in my study unless a hurricane or tornado or something absurd would happen. So there are certain things that can take away the risk of life, but they also take away the experience. So here we go. Let's experience life a little bit today. Capitalization, that is a large word. I've got a coffee mug somewhere that says I don't like big words, and I prefer to use smaller words when I explain ideas to friends and family and clients. And I don't know if you all remember when you learned to read and write back in the day, but one of the early things you had to learn with the alphabet was capitalization. In capitalization with the alphabet, that was when do you use large letters and when do you use small letters. And so there was a building block to language from using capitalization. Well, capitalization in the form of business is a building block as well, and it's a completely different idea than those of the alphabet. But that's the way you can think about it. Capitalization in the business world is the sort of finances that a corporation might have. And so when I was thinking about this, I looked up what Merriam-Webster said about it, and they said capital is relating to or being assets that add to the long-term net worth of a corporation. You basically, in business, you have two sorts of powers working against one another. One is an asset. An asset is something you can own. It's money, it's things like computers, it's cars, it's buildings, it's all sorts of things. And so the assets are part of a building or a part of a business. You also can borrow money to buy assets. You can borrow money to buy computers and things like that. And so loans are things that you borrow from somebody else in order to buy assets. So for example, if I borrowed money from somebody today for a business, you would give me that money, and in exchange for that, I would give you an IOU, which the marketplace calls a bond. And that IOU says I will pay you a fixed amount of interest for a specific period of time, and then I'll pay back the principal to you at the end of that period of time. That's a bond. Well, when I take that money on my balance sheet, I would increase the value of my cash because you gave me money or cash. And then I would also increase the loans that I have, and on a balance sheet, those are called liabilities. The net effect of those is that I don't really have more money that I own because I have borrowed that money as well. So they zero each other out. I might increase my cash by $1 million, but then I also increase my loans by $1 million, and cash minus loans is what's left over. So capitalization, again, is relating to or being assets that add to the long-term net worth of a corporation. Well, loans are part of that capitalization because it increases the asset base of a corporation, but it's different than other forms of capital because it also requires you pay back that money. So when you hear somebody talking about capitalization, they're saying, how is a business financed, is basically what they're saying. So there's really only two ways that a business is normally financed. One is you loan, you borrow money from somebody, or investors loan money to you, and that's a debt, that's a liability. Those things are the same. So a bond is the corporation lending money to investors, and so that's one form of capital that you have. Second form of capital is stock or ownership of that. As a corporation, you sell ownership to investors, and what an investor gets differently from owning stock than a bond is they don't have any claim on the corporate assets if the business goes out of business. The bondholders have claims on their cars and buildings and things like that in a particular order that's defined in corporate documents. So you have those two ways of funding a business, a loan or ownership. And so ownership is stocks and loanership is bonds, okay? And what we're normally talking about on Curious Investors is stock ownership, because that is where we want to try to learn to capitalize ourselves in making more money with the resources that we have. So capital, this is really a big deal with the election. There was a divergence of opinion between capitalism and socialism, and I'm a capitalist, so that's where I stand on these things. There's a basic economic structure or belief system or principle. I'd say it's more of a principle, is capital flows where it is most respected. You understand that? If you've got savings, it's going to go to the place that it's most respected, because people don't take their savings and give it to others who don't seem to have a concern for that money. They just don't freely do that because they work too hard for that money, and they want to find a place to put it where it's respected and will be treated reasonably. So capital flows where it's most respected. If you can believe that, accept that, and think about it with your own money, that's probably going to save you money. Okay? Capital will flow where it's most respected. Think about it this way. Would you loan money to someone who you don't expect to pay it back? Think about it. Over the years, my wife and I have had people ask to borrow money, and we've learned through that process that is a good way to lose friends. If a friend can't get a loan from a bank, then the bank says they're not very trustworthy with paying back a loan. And if they can't get a loan from their own family, it says that their own family doesn't trust them to pay it back. So then the third place people would go is to a friend to ask to borrow money. So think about that. So if the bank says no because they don't believe they'll pay them back, and their family says no, that they don't believe they'll pay them back, what do you think the probability of somebody who borrows money from you that's not family paying it back? Probably not very high. And so you would have to take into account how much respect do you have for the person that's asking to borrow money. Well, if you don't think that they're going to pay it back. You may lend them $100, but you're not going to lend them $100,000 unless that's pocket change to you. Same thing so that would be on the bond side of things. So corporations, when they borrow money and people lend it to them in the form of bonds, those corporations, their reputation is rated by rating corporations. The higher the rating, the lower interest rate they generally have to pay, and generally speaking, the more security that the bond holder has that they'll get their money back at the end of the duration. There's no guarantees with bonds. Maybe U.S. government bonds, there's a guarantee you'll get your money back based on the full taxing ability of our U.S. government. However, if you lend money to a corporation, you'll want to look at the rating of that corporation to see whether they're trustworthy or not to pay back that money. I'm not a big corporate bond investor myself, so I don't spend a lot of time concerning myself with that aspect of it. But that's true. Would you lend your money to somebody you didn't expect to pay it back? How about, would you invest in a company with shady leaders? If somebody you knew who was not trustworthy or honest was running a publicly traded company, would you put your money in that corporation? Probably not. I had to do a research paper while I was in college and provide an opinion about a publicly traded company during that time. And when I did the research on it, I discovered that the leadership had done a number of dishonest things in the years past. The information I saw about their dishonest actions was recorded in publicly available magazines and newspapers. Not to say that those sources of information are always honest and true. However, if there's kind of a public trail of doubt, there's enough other places to invest in companies that you don't have to take that added risk. And so if I remember correctly, it's been a number of years ago, my opinion of that company was that because of the leadership's lack of character, that it's probably not a good place to invest and may well be a good place to do what's called selling short, betting against the company, betting that their stock price goes down. And I'm not clairvoyant, I don't know the future, but that particular company ended up going out of business. So you want to invest in a place where your capital is being treated reasonably. And so on the stock side of things, where are things being treated reasonably? I think a reasonable place that your capital would be respected is like one of the ideas we talked about last week. What companies are creating new and interesting products and services? Those people are not just taking your capital and taking their salaries to keep the company moving along. They're taking your capital, they're paying their employees with some of that, but they're also taking that resource and creating bigger and better ideas for the future. And so I would say one place that you could know that a publicly traded corporation respects your capital would be those that are creative and considering new ways to grow the business on your behalf as a shareholder. Let's see here. Companies that are traded in the marketplace are referred to as large capitalization, mid-size capitalization, and small capitalization. That is a mouthful, and often you'll hear maybe even us refer to things as large cap, mid cap, or small cap, which I apologize if we use those terminologies because they don't really say anything. What capitalization really is, when you're talking about the stocks of a company, the stock shares, it is the number of shares times the price per share is the capitalization. It's not what you perceive how big a company it is. It's just you multiply the number of outstanding shares by the current price, and that tells you the capitalization. Different markets have different ways they treat the capital. For probably the last decade, large cap, very, very large companies have been the preferred place to invest capital. It's not a permanent thing, it's a cyclical thing. And so people have made a lot of money putting their money in like the S&P 500, which represents large capitalization type stocks. Well, those stocks don't always lead the way in the marketplace. And so to put it in there and assume that they're always going to lead the place is just a false narrative. It's not the truth. Mid-sized companies sometimes lead the way, and small-sized companies sometimes lead the way, but you don't know unless you pay attention to what's going on in the market. Let's take a look here at something. I want to point out something to you here. I am definitely not recommending this company. I saw this one this week. It's called Avino Silver and Gold Mine. Let's see if I can find the data I'm looking for on here. I know it's on here, just not seeing it right now. Grief. Oh, here it is right up here. Can you see this right up here? Market capitalization, $97.7 million. That is small capital. It may sound like a big company to you and me, but if we punch in Google over here, that was 97 million. Google is 1.2 billion dollars. No, it is $1,200 billion of capitalization. That's huge. Then if we punch in Apple, I haven't looked at it in a while. There you go. I think that's 2 trillion. Is that what that is? That's huge. So those companies are going to act differently than the small one that I showed you that was 97 million a while ago. They're going to have different personalities. There's going to be different risk associated with each one. And so understanding the size of a company can give you a better perspective of how you're investing in the marketplace. Most of the curiosity over the last 10 years, like I said, has gone to those large cap stocks in the S&P 500 and things like that. Let me show you an example of that here. The NASDAQ is just an index of stocks, and if we look at this thing, it peaked out over here in 2000 at 5,000 was the level that it was. It took from that period in 2000 all the way over here till 2015 to break even, from that high to over here. So NASDAQ large cap stocks were out of favor for that period of time. Now, if I go in and punch in an index of small size, this is the S&P 600, it peaked out about the same time. It rallied back to a peak here in 2007. We had the 2008 debacle. It sold off in 2008. And again, that thing rallied to newer highs later from there. And then the mid-sized companies would be represented by the S&P 400. And you can see with this one, it's had almost a more steady process than even the NASDAQ. So those are different sized companies, different markets, and different types of ways to invest. I would say a good thing to know if you're wanting to invest in stocks is which one of those marketplaces seem to be the best place, the best one that's taken place in the world economy. So you wouldn't even look at just small, mid-size, and large cap companies, but you could also then begin to integrate in your research process what economies are doing well. Like if the US economy and the US stock market's going down, if you've got a process in place and you're looking around the world, there may be world economies that are thriving when the US economy is not. And those stocks, a lot of times, are available on US stock markets. And so you can invest not only in companies that are based here, but you can find publicly traded companies that are based around the world. Again, there's added risk with different ways of investing, and investing in international companies brings on a whole different risk than, say, buying US corporations, because there's different governances there, there's different freedoms there, there's different access to those things. And so they all come with risk that can change your capital's value very quickly. So capitalization is the financial structure of a company. It is often referred to as cap. So if you hear the word cap, mid, small, large cap, it's talking about how is this company financed. It's not any more difficult than that. It's not any more complicated than that. But just like most industries, the investment industry, we have a weird set of words that we communicate with, and it's not a very helpful way to help curious investors build their skill set by using those clandestine words like capitalization. Hopefully I've given you a good description of capitalization and how that works. Are there any questions before I wrap up today that I can answer for you? If there's no questions, feel free to email me. My email is down in the corner of my picture there. Feel free to reach out and suggest other topics that you want to learn about investing in a curious manner, and we can incorporate those in the weeks ahead. In the meantime, I hope you have a spectacular week. I hope you're able to follow up on some of these discussions and formulate new ideas to help you become a better, more curious investor. Have a great day, and I'll see you guys next time.